Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the first weekly economic review of the month of March. So spring is at our doors. I'm here with our chief economist, Clément Gignac. So good morning, Clément.
Good morning, Sebastian.
So we are recording this on Friday morning. It's close to 10 a.m. Markets are looking for a direction again. We'll look at where we are standing at after 4 days this week. So the rise in interest rates continues. So this is one thing that we've been discussing pretty much every week now in 2021, but we did discuss it also in late 2020. Interest rates were very low, and the main risks to the market was that we had a strong rise in interest rates. Of course, we did not expect it to go as quickly as it is going now, but we did expect a move. But what we are seeing here is minus 2.5% almost on the long index on the week. Year to date, you're seeing red everywhere on bonds. So of course, this is a very strong headwind. So is there an end to this move? We don't know yet, but we'll be discussing exactly what happened this week and how the market is reacting to what the Fed is telling it. So equities this week, EFI was higher, emerging markets higher, TSX higher, and in the US you have a down move. So the winners of 2020 are losing out to those that lagged a little bit in 2020. So we're seeing this rotation under the hood. So it continues this week, and the Nasdaq now is in negative territory for the year. So after a very strong start, it is close to correction territory. If we have a negative day today, we could see a negative. We could see officially a flag of correction next to the Nasdaq, which would mean a 10% pullback since the recent peak, which was on February 12th. So still to be confirmed, the market seems to be volatile again today. Oil higher because we had a surprise non-rise in output from Saudi Arabia and Russia, so supporting the price of oil, which is already up close to 32% year to date. Canadian dollar up following the price of oil. The euro is down, and gold, since you have a stronger US dollar and the rising rates, well, two headwinds for gold, which is up more than 10% so far year to date. So vaccinations. So on the left, you have the current hospitalizations in ICU, Canada, and all of the provinces here. Nothing really to tell here. The trend remains favorable, but we'll focus today on the vaccination. As you can see, Israel is pretty much done, 97.5% of the population vaccinated. After that, you have the UK, the US, so 31%, 24%, and then you have Europe and the rest of Europe, and you have Canada. So it's very important that we pick up the pace in vaccination now, and we have a good example here with the European data. I don't have the Canadian data here, but the story is similar. So on the left, you have two lines. So you have the black line is the daily average number of, so it's thousands of people, the number of people that are vaccinated every day, the black line. So this is the pace. And the light blue line for each country is the daily average that is needed to reach herd immunity by the end of the year. So as you can see on the top, the US, the pace is faster than what is needed for herd immunity before the end of the year. Good thing. On the bottom, you have the UK, same thing. But Germany, France, and Italy, the pace should have to be about 2.5 to 3.5 times quicker for them to be able to reach herd immunity. So there are two things: how the vaccination campaign is organized. So in Europe, we hear more of that. It's more there's pressure on politicians that the campaign is not efficient. In Canada, it's more about the availability of vaccines. So this week we had Mr. Biden claiming that every adult in the US could be vaccinated by May because the pace would satisfy it. So that means that there will be some spillover after that to Canada. It will be easier for us to get vaccines. Good thing. And in the meantime, we have the AstraZeneca vaccine that's coming, that's been approved. The Johnson & Johnson vaccine has been approved in the US, not yet in Canada, but it's just about to be. So we expect a very strong gain of pace for vaccination in the next few weeks, but we do need it to reach herd immunity by the end of the year. But the US and the UK are well ahead of Canada on this one. more signs of inflationary pressures under the hood. Here, the ISM manufacturing index, there's a subcomponent that they call the supplier delivery. So the higher it is, that means the longer you have to wait to get your shipment from your supplier. So of course, this is inflationary pressure under the hood. We're almost back to the level of when COVID hit, and it was because businesses were forced to close that it was harder. It was not really pricing pressure under the hood, but now it's starting to be more pressuring, and you would need to go all the way back to the mid 1970s to see figures as high as this. So inflationary pressures keep on building. So expect a pickup in the pace of inflation in the next few months. Labor market now in the US, we had the jobs report today, beat expectations in February with a gain of 379,000 compared to a consensus of 200,000. But as you can see on the chart on the left, this is a 12-month variation. Well, we're still down about 10 million jobs in the US, so 379 is good, but we need more months like that, and we need an acceleration in the pace to wipe out all of the impacts of the COVID. So the mass vaccination should support it. So we'll be focusing on that, but we do expect more and more jobs to be created as we move along in the year. But mostly we need that to be able to have a fuller, more inclusive recovery. So when we open the service sectors again, that should help. Finally, in Canada, a strong end to a difficult year. Q4, we had the GDP data for December coming out this week, so that means that we have Q4, which clocked in at 9.6%. Very, very good end to the year. Q3, as you remember, was above 40%. But for 2020 as a whole, contraction clocked in at minus 5.4%, so a bit below the figures in the US. And the consensus for 2021 is that we should have growth of about 4.5%. So again, we should lag the US economy here, mostly because the pace of vaccination is much slower here than south of the border. But in 2022, we could see the Canadian economy outgrowing the US. So very interesting, a few months ahead of us. So that wraps it up for the economic part. So now for the financial markets, I hand it over to you, Mr. Gignac.
Thank you. So very, very interesting time. So why not start with, in fact, the interview of Mr. J. Powell, the Federal Reserve Chair, with Wall Street Journal on Thursday. So it looked like that he have not convinced the market or reassured the market. So Mr. Powell, in fact, continue to maintain that the inflation acceleration that we will probably see this spring will be temporary, but he falls short of mentioning any measure to control the rise of the bond yield, because the 10-year bond yield have increased more than 50 basis points year to date. And basically, he mentioned that that kept his attention, this rise of long rates, but seems not too much disturbed as long that they have not instability in the financial market. Define instability probably, from my point of view, like a widening corporate spread. We have not seen too much, or disorderly on the stock market. So for him, clearly, he looked like no intention to go in any yield curve control, and that's the reason that the bond yield has continued to increase after his intervention, and the stock market react negatively on that. And now Nasdaq going more into the red. On the next slide, in fact, just to highlight that you have to curve. The blue one is the in stock market since October 2019, the S&P 500. So after the 35% plunge a year ago, you have seen a nice rally, close to 70% from the trough on the stock market US. But the bond yield lag, the 10-year bond yield, which is the dotted red curve, has in fact start to rise in a more significant way only in the last 2 months, or let's say since the beginning of the election of Mr. Biden. And with this massive additional fiscal stimulus, 1.9 trillion to be have been adopted, clearly, people start to have concern because the 1.9 trillion stimulus is more than the current output gap. So it seems that people have more concern that maybe with some heading to some inflationary pressure, and maybe the Fed will start to pull the trigger before 2024. That, indeed, Mr. Powell yesterday has mentioned that Federal Reserve will be patient before increase interest rate, but patient do not mean never increase interest rate. So they will increase interest rate. So it's another indication that the Fed working not with the calendar, the Fed working with an environment that could determine if they will increase interest rate or not. Anyway, I think that we will continue to see a lot of volatility on the bond market in the coming days until the FOMC meeting 10 days from now, as you have mentioned. On the next slide, we have this rotation on the Wall Street. Notice you have two curves on the left. You have the blue one is the Nasdaq, and the dark one is the in fact the S&P 500 back to early 2020. You can notice that even if the Nasdaq is now in the correction mode with 10% decline from the mid-February peak, is still 45% above the level of the pre-pandemic. On the S&P 500 is 15%. But notice under the hood, they have a huge rotation going on. Notice on the right side, you can notice energy, materials, in fact, if the banks, so they have a rotation, furious rotation, I have to say, given this increase of bond yield. So it's more favorable for banks than technology sector, energy. Even Saudi Arabia surprised this week by mentioning that they have no intention to increase production, despite the fact that we have a significant, in fact, a tighter energy market. So all of that support the energy sector since the beginning of the year, and particularly this week again. On the next slide, talking about this rotation, notice on the left side is still my dotted red curve, the 10-year bond yield that we have shown before, but the historical data now is back to 2018 that come from, in fact, bank credit analyst, and we can, Alpine Macro, excuse me, and the blue one is the FANG, so Facebook, Apple, Amazon, Netflix, Google. Notice the significant increase of the FANG performance over the last 3 years. They have benefit of the decline of the bond yield, but since the bond yield has started to rise, now you can notice that they are more shaky. On the right side, just to illustrate this shift from growth to value, we have illustrate over the last 25 years because we want to illustrate what happened in 1998, 1999, even if it's not a bubble as we speak, or we don't believe it's the characteristic of bubble because the FANG company make money, contrary to the dot-com who have not make any money at all. So, but notice is disturbing nonetheless, this two curve. The blue one is the Nasdaq. It's a ratio, Nasdaq compared to Dow Jones Industrial. And notice the other one is the red curve is the S&P grow compared to the S&P value. So you can notice one fit to the other because Nasdaq is more technology, is more growth. But right now you have this rotation. Make no mistake, Nasdaq is not cheap. They still trade above 30 times forward earnings, and so compared to Dow Jones, it's much less than 20 times earnings. So in such circumstances, if we arrive with this vaccination campaign acceleration, every adult in the U.S. expected to get the vaccine before June, apparently, according to Mr. Biden. If it's the case, and you have acceleration of the economy significant, bond yield will continue to rise and at some point reach 2%. This rotation will continue from my point of view. And this is our strategy, Sebastien and myself, in different mandates. We, in fact, in the diversified funds, we have the opportunity to increase the banks weighting in the energy, and this is what we're doing. So clearly, we think this rotation is far from over. So I've been long a little bit, Sebastien. My apology for that. We have a lot of things to watch next week.
Yeah, sure. And just an interesting thing, while we were recording this, we just had the news that the Johnson and Johnson vaccine has been approved in Canada. So one more thing in the column of the good news. Canada next week will have the Bank of Canada rate decision. Don't expect any change to the leading rate, but let's see if the Bank of Canada reacts differently to the rising rates environment. Of course, it's not just in the U.S. that interest rates are rising. In Canada, it's the same thing, the steepening of the yield curve. So we'll see how the Bank of Canada reacts. We'll have the net change in employment in Canada in January. Remember, we had a very bad month with all of these restrictions. In February, restrictions remain, but we'll see if employment behave differently, and the unemployment rate also will be out. In the U.S., wholesale inventories, we don't discuss inventories too much, but we know that the level of inventories is pretty low everywhere. So one more kind of inflationary pressure element. So we'll see how the buildup in inventories goes. Other than that, the CPI inflation for February, we should start to see an acceleration because now the year-over-year effects will be taking into account the beginning of the COVID period of last year. So we'll see how these figures behave. We'll have the jobless claims, and finally the consumer sentiment index from the University of Michigan. So that wraps it up again for the week. ia.ca/economy is your go-to webpage. You can always subscribe to the newsletter if you haven't done so already. If you want a PDF copy of this presentation, economics@ia.ca, and we'll send it to you. So thank you everyone for your trust. Thank you, Mr. Gignac, for your insights.
You're welcome. Have a nice weekend, and the weather will be warmer apparently next week after the spring break that we have in Quebec. It was pretty cold that week, so better time coming.
Yeah, some more good news ahead. So thank you for that. Thank you, everyone. And we'll be back again next Friday with a new edition of the Weekly Economic Review.